Thank you everyone for joining. I'm Becky O'Mara with the American FinTech Council. I'm really excited to start our newest edition of our Future Finance webinar series. Today's topic is Breaking Up is Hard to Do, Bank FinTech Partnerships in Times of Stress. And this is hosted in collaboration with Davis, Wright, Tremaine, a member of our legal advisory council. So very excited to get started. And without further ado, I'm going to pass it over to our moderator, Bradford Hardin, who's a partner at Davis, Wright, Tremaine. Bradford?
Great. Thanks so much for the introduction, Becky, and thanks to everyone for taking some time out of your day to join us for this webinar. We'll get started in just a second, but before we do, let's have our panelists introduce themselves. I'm Bradford Hardin, as you heard, a partner at Davis, Wright, Tremaine. My practice focuses on consumer finance and payments compliance and enforcement matters. Dafna, do we want to go to you? You're next on my screen.
Sure. So Dafna Dothan, I'm the Chief Risk Officer for Cross River Bank. Cross River Bank, I'm sure everybody knows, is all about financial inclusion and the partnership, bank partnership model. Thanks, Bradford.
Awesome. Amy?
Yeah, hi, thank you, Bradford, and thank you for allowing me to be on the panel today. Super excited about it. I'm Amy Pugh. I'm General Counsel. I'm also the Interim Chief Risk Officer of Green Dot Bank. I joined Green Dot less than 2 years ago. And we are a bank that is a fintech bank. We have been called the OG of fintech, which we would probably like to proclaim. We specialize in, of course, working with underbanked and then also facilitating banking as a service partnerships.
Great, thanks. Jason?
Hi, afternoon. Great to be here. Jason Cave. I'm a former regulator, spent 30 years, most of it at FDIC. Started as an examiner, worked for Chairman Bear during the great financial crisis, and went over to FHFA, did a few things, including launched their fintech office. So now I am working with clients in banking, mortgage finance, and tech, and having a lot of fun. So great to be here today.
Welcome. Okay, Ryan?
Hey, yeah, I'm Ryan Richardson, partner at Davis Wright Tremaine with Bradford, though I sit in New York. My practice here focuses on financial partnerships between banks and non-banks, usually for fintech products or services. Before joining the firm in January of last year, I spent 5 years as the lead partnership lawyer at Stripe, and have also had a career prior to that in private practice, also focused on partnerships, and before that as a regulator with Jason at the FDIC. So pleased to be here.
Awesome. So as everyone can see, we have a great panel with a number of different perspectives on today's topic. So I think this is going to be a really engaging hour. We'll just dive right into it. I'll start by doing a little bit of setting of the table, and then we'll go around and have a discussion, I think, really from the trenches on this topic and managing these bank fintech partnership relationships through what has been a time of significant stress over the last couple of years. So in terms of setting the table, how did we get here, right? I think it's fair to say that the period from 2010 to 2012, maybe going forward to 2022, was one of significant expansion and growth in the fintech industry, and particularly with respect to this idea of bank fintech partnerships. Around, I guess, 2010, 2011, somewhere in that range, we saw the first neobanks, Simple and that cohort that really were based on a prepaid account model. As time in the industry developed, we saw a proliferation of different types of bank fintech partnership models. Many of the largest ones today are based on deposit accounts, credit card accounts, savings accounts, and the like, although the prepaid account-based products are still very much in market and successful in their own right. And these structures are ones in which the fintech performs a lot of consumer-facing or public-facing functions, including customer acquisition and marketing, application processing, underwriting on a delegated basis, account servicing, even collections in some instance. So you have, very public and consumer-facing role for the financial technology company, at least as we're primarily focused on here today. And then the bank is focused primarily on doing the core banking activities of accepting deposits, making loans, and paying checks or processing payments in the more modern vernacular. So there is that division of responsibility, which works quite well together, because I think it plays to each partner's respective strengths. So that was great, and it still is great in a lot of respects. But a couple of years ago, this whole ecosystem came under great stress. I think there are a few reasons for that, from having watched it over time. One was the bursting of the tech bubble in the end of 21 or beginning of 2022. That resulted in the pullback of a lot of venture capital funding for the fintech side of this, for the fintech side of these partnerships. That really changed the operating environment for the bank partners in a lot of respects, particularly the ones that are a little bit earlier in their life cycle. So that became a big kind of viability crisis for a number of players in the industry, which obviously has an impact on their bank partners as well. So that, I would say, is kind of one factor. Another factor was just the increase in interest rates, which is, had impacts across the banking industry. But in this space, you had a lot of companies that were built and designed their business models in a very low cost of capital environment. And when that changed, of course, the economics of those businesses in many cases changed. And that has, put a lot of strain on these partnerships, including, really in some ways undermining some of the assumptions that went into the economic arrangements between the two parties. And then finally, and this is maybe the hardest learned lesson, we've seen that compliance wasn't always prioritized in this atmosphere, and there was a competitive environment in some instances among the banks, and a just ship it mentality among some in the fintech ecosystem, and that's caused some breakdowns and tensions in these partnerships. So there's really a perfect storm of factors that has led to a pretty challenging time, I think, for bank fintech partnerships in the main. One of course thing that we have seen more recently as the aftermath of this has kind of come into present view is an increase in enforcement activity, both at the federal and state level. And so in the spirit of providing full context for our discussion today, maybe I'll pass it to Ryan and have him give a couple of minutes on the enforcement environment here.
Yeah, glad to. Thanks very much. I think by the sort of folks, particularly great journalists in the trade press who follow these data points pretty closely, I think we can roughly estimate around somewhere 30 plus in public enforcement orders touching partner banks and fintech partner relationships since 2020. And if we estimate also based on data from Bloomberg, et cetera, that there are roughly 150 banks in the United States that focus primarily on fintech partner relationships and products and services for fintech businesses. If we then compare that to more than 30 of those have seen enforcement activity in the last 4 years, that's more than a quarter of that ecosystem. And so that's pretty remarkable, I think, by comparison to the larger ecosystem of several thousand insured depository institutions in the country. I don't think it's worth it in this forum to spend time particularly on any specific enforcement order, but instead to think about some of the through lines that we see through those 30 actions over the last 4 years, and in particular, maybe even the sort of the dozen or so that I think have been the subject of recent headlines over the last 18 months. I think almost uniformly, maybe with sort of one or two limited exceptions, each of those orders has some focus on deficiencies in board governance and board oversight, right? Like that is probably the most ubiquitous citation of risk management deficiency. And then on substance, you see also quite a number focused on AML and CTF deficiencies and other sort of general third-party risk management oversight deficiencies. And then of course, the challenging consequence that we're seeing pop up more and more in these enforcement orders are specific limitations on new or different business activities, right? So in order to make a change to business activities or even launch new products or even new features on products, institutions that are subject to these enforcement orders need to go back to the regulator, explain those new launches and get approval for them or non-objection for them. Which of course creates quite a bit of friction both for the bank and for their fintech partners in terms of speed to market. And in most of these orders, as most of this crowd I'm sure knows, having looked at many of these orders before, specific facts behind these deficiencies are often not laid out. Though we are able to glean some of those facts through reporting after the fact and or trade press and the like. And similarly, specific relationships typically aren't named, though there have been a few notable exceptions where enforcement orders have called out specific relationships between financial institutions and fintech partners. And in fact, in at least one or two cases, the enforcement order being based entirely on a single partnership between a financial institution and one fintech, that's quite uncommon, but we have at least seen it. And I think most relevant to the wind down and termination concepts that we're going to be talking about today. Of course, our focus is on governance, as we talked about, sort of board governance, but also just general third-party relationship management governance. And also, I think one thing specifically to call out as we think about breakups are the focus that we see through these enforcement orders on data flows and tools that the financial institution can and should be using to understand the day-to-day operation of its relationship with a fintech partner, and in particular to make sure that there are sort of data flows in place to ensure that accurate and complete records, whether that's financial records or customer records or basically any sort of information about sort of day-to-day operation of a fintech product or service that's sponsored by a bank, that information is readily available to the bank so that it either can continue the service or wind it down in the wake of a breakup. And I think if we read between the lines on a lot of the deficiencies cited around InfoSec and in data flows, I think that is in fact what many of those deficiencies are getting at. Not all, but many. So that's to call it high level is probably even forgiving, but a high level overview of the enforcement landscape that we've seen relevant to these types of relationships over the last 4 years or so.
So, Amy, one thing that I certainly have learned from representing clients in this space is that when some participants in the industry are on the receiving end of public enforcement actions, that means everybody is getting different forms of private pressure around the same or similar kinds of issues. Could you speak to us a little bit about what the changing regulatory environment or expectations are as it relates to these partnerships and any of these issues that Ryan touched on, or other developments that you're seeing in this environment?
Yeah, and thanks so much, and thanks for the background. I've been in the financial business for quite some time, and the downturn back in the 2008, 2009, and seen these kind of ebbs and flows. I sort of see it as obligations are always there. The requirements have always been there, right? We've always had laws, rules, and regs. The tighter scrutiny that we may be seeing on some of these activities has been more recent and holding banks to a certain level. And that's where I think has maybe created some of the rub, I think, for some of the banks that are in this area. But I do think that, the requirements are always there as a fintech partner, really stepping in the shoes of the bank, if you will. That's how I've always kind of described it for years. I think even more so now, it's important for fintechs to know that. So as a bank herself and as a fintech, trying to explain those obligations and those roles, I think is going to be key, and key to understanding how to move forward in the relationship. And as Brian was talking about, and if you get to the point of the breakup, which of course nobody ever wants to, but you need to be prepared for that. So I think setting those very, very specific expectations is more important than ever. Understanding sort of your role, your obligations, who's doing what, being very detailed, is first and foremost in my mind.
Yeah, certainly business continuity has been a topic in the third-party risk management guidance for quite some time. And Jason, maybe we'll come to you on that guidance next a little bit. But it does seem to me there's a little bit of a different flavor to business continuity today. Do you share that view, and has that been your experience? Maybe Dafna, you have a thought about this as well, but maybe Amy first.
Yeah, I think that, we need to be thinking of these customers as a bank customer first and foremost, right? Whether they come directly to the bank or through a fintech. So you need to be completely prepared for that life cycle, right? And business continuity is one part of that. And I guess I want to make certain I'm understanding your question. When you talk about continuity, is it the continuity of the relationship and after the breakup, or actually of the service being provided?
Yeah, of the service,
Yeah.
really. Yeah.
So the service being provided, you need to make certain that if you've got partners, they're really standing in your shoes, they're a part of you, right? So all of those pieces are going to work as they should. So you should be understanding the API connections, reviewing them, having those IT assurances that those things are going to work. And if there is some sort of failure, how are you going to make certain your customers have access to their funds? A lot of times that these relationships, and I think one of the things you guys touched on is they've opened the door for a lot of underbanked and unbanked people, which having access to funds is very, very important. So we need to make certain that there is no hiccup, that you're going to have really strong connections and backups and failovers and things of that nature. But I do think that's key. I think that regulators are honing in on that, which I think is appropriate.
Dafna, is a greater emphasis on backup plans and optionality something that you're seeing?
Definitely. When we talk about backup, I agree with Amy that it has different facets to it, whether it's the ongoing activity, making sure that there's backup with the fintech, backup with the bank that's providing the services. And then if we think about a potential exit due to stress, what is stress? A stress can be some sort of an event that then requires, again, to launch some sort of a plan that has some backup elements to it, has some business continuity elements to it, depending on the reason of what transpired with the partner. So definitely something that is now very focal when we think about due diligence, when we think about ongoing monitoring. So in every kind of stage in the life cycle of the relationship, different things that we need to look at. Definitely business continuity is one of them, alongside information security and other things, to make sure that things are intact when we started the relationship and things are intact as we move forward with the relationship.
Can you talk a little bit about how that has changed over time? Do you feel like it's more formal now, or more well documented, or just explored at an earlier phase in the relationship? Or how would you describe it as being different today compared to the past?
I think the key word here I will use is maturity. And I think that if we talk about, and I think Amy said it was always there. So it's not like there is something all of a sudden brand new that no one ever knew about. But I think just like anything in life, you have something and then you grow it, you mature it, and you introduce different concepts to it. So a concept can be, and you just said, more documentation, more rigor, more structure, having that element of clear expectations. So it's not like, oh, we think they understand and they know what we mean. No, it's well documented. And part of what we're seeing now in the new guidelines that were published, again, it's not like it's something brand new, but it creates more structure, more kind of precise instructions to what are the expectations into it, knowing both sides get into it, knowing what to expect.
But I do think, just that the shape of this problem, the problem presented by continuity, has changed a bit with the introduction of the fintech partner relationship as we know it. And by that, what I mean is, if we were to go back to 2005 or 2000 or 1998, the nature of the business continuity planning that you would do for third-party relationships was defined by the scope of those relationships, which is often very narrow. Bank would have a core processor that might be the biggest business continuity plan they may need to put in place is if there's a failure at the processor. But then there were other, quite discrete service providers that were providing discrete services and performing discrete activities. in pretty narrow little segments of what otherwise would have been the bank's core operations. And today, in a typical fintech bank relationship for a particular product or service, so large swaths of activities that the bank otherwise would have performed itself are now performed by the fintech or the fintech's own service providers. So that just by nature of pushing all of those activities in one big chunk off to one partner that is then tasked with the ability to outsource those even down, further downstream, the shape of the problem changes. And as that shape of the problem changes, I think the magnitude of complexity also has increased. So just as Amy and Dafna said, that that the particular expectations around continuity planning are no different than they were 5 years ago, 10 years ago, 20 years ago. But how you do it in that new environment and with that increased complexity is quite different.
Yeah, I would agree with Ryan. And I mean, one of the things, I go back in the beginning of my, career back in the mid-90s, the issues of third party, what examiners did, what regulators did, I think it's changed. I definitely think it has evolved from what was quicker due diligence and shorter reviews to a much more comprehensive look at things. And one thing that I would say is important is in the for many years the bank regulators have been looking at the core providers and doing examinations, true supervision, very intensive reviews of all the things we're talking about and more. I think what's going on is, examiners don't have that line of sight or visibility into these the BAS relationships that we're talking about, like they do with the cores, and in some respects are saying, we want to have that, but we're not going to do it. We want you, the bank, to do it. And so that's been an interesting thing. And in fact, Governor Bowman at the Fed has raised this point and has pointed to the fact that, perhaps the bank regulators need to be doing more of those core provider type reviews of some of these other fintechs, because to put it on the banks to do it, it's costly, might not be as fulsome and the like. So it's been interesting. But I do think some of this comes from a lack of visibility and perhaps putting it on the banks, things that the examiners do at the core. And I think that is causing some challenges because you have banks that are small. They leverage their vendors because they don't build it in-house, or they don't anymore. And to then say, you pretty much have to do almost the same amount of work had you did it in-house, well, that takes away a lot of the benefits there. So a real challenge that everyone's going through.
Yeah, if I can add, and I think the word complexity is I think a very, very appropriate word, because if we think about the bank partnership model, again, going into history, when you had a bank, let's call it a classic bank, they had their own CMS, and that was it, and their own disaster recovery plan and all of that. Now, in the partnership model, you need to understand, and kind of, Jason, where you're going, where the regulators don't have the visibility, it's the oversight that's required by the bank to now understand every partner, what is their CMS, what is their backup plan, how are they running their InfoSec. So that understanding multiplied by the relationships, that adds, it's like the same thing, but multiplied.
Yeah, I love the go back in the time machine. I think about exams and how they were in the Wayback Time Machine. Like examiners in a room with boxes of paperwork is like so foreign. But I see what you're saying, Jason. I think you're right. There is a lot of complexity and Dafna. I think that's the right word that you hit on the nail. And Ryan kind of made that point. If you just mathematically look at the amount of relationships you could have under a fintech structure, it gets quite complex, right? And so you've got a lot of third-party oversight that really needs to be mapped out, understood, and I think business continuity, as Bradford said, is really important. I think one of the things Green Dot has done, and I think has managed to do well, is to keep a lot of that very under the bank. So for primarily most of our relationships, we do a lot of the pieces ourselves, which I hope has helped with regulators understanding of what we're doing. And one of the reasons we've done that is to keep control on it. So that's something to think about as you develop these relationships, because inconsistencies is going to create problems on the bank side, even though all your fintech partners want to think everything is novel and everything is new and everything is different. So it's like a little bit of competing there, whereas the bank, you're trying to make certain that it is the same and that it is treated across the board in the same manner. So, I think that these adjustments will be good for the environment. And I think it will help kind of create that new norm, which you sort of see in these cycles, I'll say, of regulatory change, if you will. You kind of go through a period of growth. There's a little bit of then kind of resistance and then some shrinking and then probably getting it right sized, is where you're going to wind up at the end. But obviously predicting the future there.
Yeah, always hard to do, isn't it? So I do want to be sure that we, focus on really some brass tacks issues here in the second half of the presentation. Before we do that, there is one topic that I want to be sure we touch here at the beginning, and that is the recent third-party risk management guidance. And Jason, I'm going to look to you primarily, I think, to, kind of give us an update on that, right? Is there something new there? Is it the same thing that has, the industry's been working under all along? Does it telegraph something about regulatory priorities? Like, how should an industry be thinking about that?
Yeah, I mean, I think first there's been a couple of documents that have come out. There was the original third-party guidance that I think got a lot of reactions of, wow, this is a lot for particularly smaller institutions to digest and handle. And recently there was a community bank guide, which I actually, it's great these days. You get a quick view on almost everything on Twitter and LinkedIn, and I know there was a lot of views on it. I actually thought the guide was pretty helpful. I thought it was written, it was clear, and it had a lot of helpful questions. And I always think if regulators are sending out a document with a lot of questions, if I'm a bank or a fintech provider, I'm thinking those questions might come up in an upcoming review. So those are probably good things to sort of be ready to hear an examiner ask us. So I thought it was helpful. I do think that regulators can say, look, this is the same as we've always been expecting. I think that that there is a lot here, and if I was a bank that was that had entered into the fintech arrangements, and I would be like, wow, I've got a lot of homework to do. The issues of a lot on again on thinking through the relationship to the end. And again, as a former FDIC person, I don't view myself as a negative person, but generally I was called in when things were not working out so great. So, that sense of there's a great opportunity, great revenue, great deposits, all these things, but what happens if it doesn't turn out so well? I think there's a lot in there that puts it on the bank to be able to make sure that the third party, is providing them of any interruptions in their service, putting it on the bank to talk about, how the third party's business continuity, disaster recovery plans will show how it recovers, and those types of things. That's you read it and you're like, oh yeah, that's very interesting. That's a big deal to put that on the bank that's working with these providers to really say, what are your continuity plans and exactly how are you going to recover? Because I've been in some situations with some large providers and I don't think they knew. And during the situation, I don't think they knew, and they weren't telegraphing it to a lot of their customers as well. So, I do think there's a lot there. Not saying it's too much, but I think that there's a lot to think about if you're going to stay in this space.
Yeah,
I think-
in a lot of ways, oh, sorry, Amy. The risks that end up being very disruptive are almost by definition the ones that were not foreseen. The ones everybody saw coming typically have some preventative measures in place and so forth. But Amy, you were gonna jump in?
Yeah, no, I was just going to say it kind of harkens back to living wills back in the day. But the financial crisis, right? It's sort of something that should have been there all along. Banks should have thought about what would happen if things changed and planned for it. Just as with, significant third parties, you should always be thinking through. I probably do this too much when I speak, but I always think of, business relationships like personal relationships, right? It's really sort of like creating a prenup, which is kind of healthy, right? Before you get into the relationship, how is this going to unwind? And then that makes the unwinding much easier. And hopefully you never do unwind, but at least you would all understand who's doing what and where. In this situation, you've got a child involved, right? You've got these consumer accounts that are need to be protected. So I get why you need to have that mapped and thought through. But I just like bringing that continuity back because it's kind of like you see this, I feel like over and over again during these regulatory kind of cycles where the regulators come back and say, hey, you really need to be thinking about these things, and documenting it better, as Dafna was talking about, is really important. Maybe you've thought about it. Maybe you do these business continuity tests, everybody does those, you do them with your partners, those kind of things, but have you really mapped out all the details when you have these fintechs, and are they doing it with their partners, and are you getting all the right information and putting it together in the right way so your regulators can understand it easily that you are covering all the bases.
Yeah, so maybe that's a good, definitely. I was just going to pivot to you and to Ryan and say that, one of the things that we wanted to discuss was, all of these bank fintech partnerships have a very substantial program agreement underlying them. That's the contract that sets out the relationship between the parties. The ones that got put together over the last 10 years don't have anything like a living will in them. I've seen a lot of them. I'm sure most of you have as well. They don't have a living will in them. But certainly as we think about the key relationships that are in place today and the ones that are going to be put in place in the coming years, what are the kinds of terms and provisions that we should think about, including in those program agreements and negotiating and working out with the bank, either the bank or the fintech, so that we have something like a roadmap for a wind down. Dafna, do you want to go first and then we'll come to Ryan?
Sure, happy to. So first of all, in terms of the agreements, I agree with you. The agreements are becoming more detailed, more including more requirements from the partners across different things, including the element of the termination and whether it's data, for example. So if we terminate a relationship, but we still need some data, what is the obligation of the partner to give us the data and not just leave us hanging because we just terminated the relationship? So I think agreements are critical, but I don't think that they're enough, because at the end of the day, the practice, whether it's again at the onboarding, so the initial due diligence is critical, but then the annual monitoring and the annual understanding or the annual review of what has happened, that will also inform us of some changes that we need to make. So let's say at the outset, we decided that this is going to be the termination plan, if we need to get to a termination plan. But then something happened in the year. By the way, it can be happened with a partner, or it can be something that happened in the environment. Does that now require us to kind of revisit that, again, hope we never get to end plan, and think about changes that need to be made to that plan? So that ability, again, in the agreement to have an ongoing dialogue, to have revisions to different things, it's also critical.
I think all of that is exactly right, and you know, and I think for you know for many years, certainly like the entire duration of my career where I've been working on these agreements, you know, there have been varying degrees of complexity and like investment in like transition planning around termination, and for what it's worth, you know, I think what we're learning here as we have seen some breakups is that those terms built for planning like the emphasis on thinking about plans for termination from a contract perspective, I don't want to say it's misplaced, but I do think it can be overemphasized, and I think where maybe to Dafna's point, where I think the better emphasis, you know, in terms of investment of resources and investment of time and negotiation and operational processes, is making sure that on a day-to-day basis, each party has enough information about the other and sort of and enough visibility to the other's activities to where that, you know, one can like walk away with actual minimal friction, so that like that the relationship and the operational cadence of it and the technology cadence of it is built to where one, like, you know, that one can walk away with minimal engineering work and minimal like operational lift, and that you're not just relying on a set of negotiated termination terms, that like the integrity and the strength of the relationship is strong enough from the beginning, or sort of from its ordinary operating cadence, that walking away from one another is not sort of not the end of the world, and is something that's actually relatively easy to pull apart.
Yeah.
And I think then like maybe a related but somewhat distinct point that we've been spending a lot of time, particularly with our fintech clients on, I think this is a little less applicable on the bank side of these relationships, but on the fintech side, is that if any of these recent breakups have taught us anything, it's that redundancy is key, right? Like having multiple partners be able to support you for the same product or service will help you avert the disaster presented by like being forced to exit a relationship to which you're single-threaded, which can be fatal to your business.
Yeah.
It is that there's you know, it is not an easy decision to make a massive investment of technology, legal, ops, strategy, et cetera, resources in redundant relationships, because they don't result in any new front-end functionality. There's no great product announcement that goes with adding a partner to do exactly what you're already doing today. But the resiliency that gets built by having even one redundant partner, so that you're not, if one gets turned off tomorrow, that you're not entirely in facing a service interruption or a you know, a customer service nightmare. I think that pays dividends, and we're certainly seeing that now. Those that are prepared with redundant partners are able to weather this somewhat quietly, exit somewhat quietly. Others that are single-threaded are finding themselves really challenged.
Yeah, I was just going to say maybe it's that FDIC connection we've got, but I was going to say the very similar thing, that, you know, you can go pretty crazy with these contracts, and but you know, let's, you know, again, I think people have to be real. I mean, how much leverage does a small bank have with these very legally written tight contracts to either really negotiate it or really have the discussion, well, exactly how is this going to play out? I mean, it sounds very good, but I can tell you, I worked on large bank living will plans, and Amy was talking a bit about that, where we dealt with large SIFIs and the need to ensure operational continuity. And they had some challenges with making sure that they could have that happen. So, you know, you think about the, smaller institution, that's a tough thing. So the mitigant, I believe, is, as Ryan was saying, is have some redundancies, have some backup providers, and that's going to go throughout your operation, deposit networks and other arrangements to be able to say, if anything happens with this, whether if there's a cyber attack, things are shut down, that I've got this other party that can step in and keep this going. I think that's going to be the type of mitigant that I hope regulators are looking at versus expecting the bank to be able to really go all the way through the contract and say, we know exactly how this is going to play out, because I think that's a real challenge to be able to do. So the mitigant to me is having some of those on reserve. So I would agree with Ryan on that.
Yeah, I've had the unpleasant experience of trying to enforce a contract against a party that's going out of business, and it's just like quicksand, you know? I mean, you have no leverage over a company that's winding down its operations, to say the least, because they usually have no assets by that point. Well, I love the idea of redundancy, and certainly that's something you've seen as a trend on the fintech side, right? I don't want to be dependent on one bank. I'm going to get 2 or 3, some number lined up with the right technology so that I can kind of hot swap if needed. What does that look like on the bank side, right? Because let's say you're a fintech sponsoring bank and you've got a large successful partner that in a lot of respects owns and manages your customer relationships. What does redundancy or mitigation planning look like on that side of the table?
Yeah,
Any
before we
ideas?
jump to that, I don't want to downplay, and I agree with the redundancy concept, but I also don't want to downplay the importance of contracts. And understood, if somebody's winding down, you do lose some leverage there. But understanding the roles and responsibilities is extremely important, and documenting it, right? So having something that cements it so you can understand it fully, and your regulators should be able to understand it from your documentation. I do think it's important. And that's how I met Ryan back in the day. We were against each other at one point, and then I grew a lot of respect for him because of the things he required, I think the things I required. And we've been friends honestly since, but you know, we sit at other sides of the table kind of hashing out like who does what, because it is, I will say that I do think, you know, not to sidestep the contract completely, because I think that that's very important, and your regulators are going to look at that because they're really looking at your paperwork, right, and your documentation to be able to judge you. But getting back to the banks, you know, side of it, obviously, as long as, you know, you have your commitments covered from your partner, you know, they need to be able to protect themselves just as you should be able to protect yourself, right? So, you know, if they're moving towards other relationships, I think, you know, as long as you have your commitments there, and that would be something that you know you would want to build into your contract, then you shouldn't be, you know, it should be a good thing that they're thinking about it, right? And then, I mean, the way I look at it, and I've always perceived it, whatever service I'm providing, you know, we are working every day to win over service. It's not going to be because we've contractually required you to be with us. It's because you want to be with us, right? Like a good relationship. So I think that it will be welcome, you know, as long as you have the right protections. I don't know, Dafna, if you have thoughts differently on that.
No, I agree with you. At the end of the day, as a bank, you know, each relationship is a relationship we want to keep and maintain, but then we can't hold anybody hostage either. But I think that with the service that we do provide, with the level of expertise that we have, that's why we have the partners coming. I can understand when partners want, again, going back to what Ryan said, want to create the redundancy on their end and maybe not have just one bank partner. But then again, it depends on different conversations, and it's really a case-by-case perspective.
I guess on the maybe one more tactical point, Bradford, is that I think as you think about the bank, as we think about the bank side of a breakup, of course, you have to maybe to oversimplify, you have to bifurcate it a little bit about the nature of the breakup, right? Are we talking about a breakup where the fintech partner is just taking the relationships elsewhere? And so, like, what does succession look like in terms of bank A transferring relationships to bank B? That's something that it's a pain, but like it's something that you can plan for, and also it requires you to develop the specific circumstances or apply to specific facts and at that time. But like the more painful process is what to do. Like, you know, how does a bank think about continuity when the fintech partner isn't there anymore, right? And this is certainly something that we're all aware of in the news right now. And that is a harder exercise, right? But I do think it turns into assessing sort of the minimal functionality and hot handoffs required to, at the very least, wind down those end customer relationships efficiently and effectively. And so, what information and services do I need from the fintech partner on an ongoing basis, not at the time of transition, but like on an ongoing basis, so that when the moment of transition or wind down does present itself, that I'm not left asking for to your point, Bradford, I'm not left asking for a bunch of data or a bunch of information from my partner, who, like, frankly, is probably, like, it went from a cast of 1,000 to a cast of 2, and they're turning off the lights and unplugging the computers and going home, right? And so, that's a planning question about ready access to accurate and complete information, and ability to hand that information to the bank's own service provider quickly and efficiently, to, again, at the very least, be able to wind down that product and communicate with customers about it, much less keep it turned on.
Yeah.
So I think, just if I can add, Ryan, to what you were saying, when we think about it, there are like different scenarios and different playbooks that we need to have for the same partner. It can be like a planned separation. Maybe the contract was timed and we know that in 5 years they're going, or maybe something happened, they want to take their business elsewhere, but it's not like we need to turn the lights out, or they're turning out the lights out overnight. And then there is stress event. And for each scenario, we should have a playbook where we know how we're doing it. And if it's a backup servicer, as an example, so if something is going to happen to the partner, we're already warming up a backup servicer, so we know that there is an ability to transfer. So there is a lot of thinking that is required when we do these types of plans, although it's for not a pleasant occurrence, but I think it's part of our responsibility to have these plans as well.
Yeah. Yeah. The thing I keep thinking about, like, all these discussions, they're necessary, and I think they are definitely going to be getting much more intensive going forward. I mean, and with an expectation from the regulators that there's clearer, concrete answers on some things that are up to now have been kind of hazy. And what I though keep thinking about is, how is this going to be done? Like, are you going to have 50 BaaS banks calling some of their providers all at the same time, asking 50 questions that are kind of like each other? And then, like, how, like, to me, and that's why I've been looking at some of these concepts. Some people have been talking about, getting some consortiums or some other parties to help, rather than have the question asked 50 times in varying degrees, some questions better, some questions not, and then getting different answers. Having somebody that, or some parties that can really go deep to say, here's how this plays out for this provider. Here's really how it plays out. Here's what you need to know. Based on that, what additional questions are you comfortable? Are you less comfortable? Like, to me, I think this is going to be a very big endeavor, and it's going to be important, again, because I keep thinking about the size institutions, to make this as palatable as possible, so that everybody isn't just going off, and because then I'm thinking too, on the provider side, they're going to have all these people on the phone, explaining it. And is it better to do this a couple of times, or are we really expecting everybody to go through this 50 or 60 different times? That's where I'm kind of wondering how that's going to play out.
Yeah, well, to Amy's earlier point about these regulatory cycles, right? There's definitely a couple of risks at this point in the cycle. One of them being, regulators fighting the last battle or overreacting to isolated but prominent examples of a particular issue. I think there definitely is some risk of that in the current moment as it relates to this, because, Green Dot and Cross River both have been operating these types of arrangements successfully for many years, right? And so to paint the whole ecosystem with a broad brush based on some relatively few failures in the scheme of things, I think would be a significant overreaction. I guess a similar point is, that this is a area of innovation that has actually created a lot of good. It has created financial inclusion. It has created access. It has given people, the ability to get their pay early when they're very cash constrained. It's reduced the cost of credit. It's given them access to direct deposit when they formerly were check cashing type customers, and all of these things that have improved the financial lives of many Americans. And there is some risk of throwing the baby out with the bathwater, so to speak. And, that certainly is to be avoided.
Yeah, I think getting back to Jason's comment, though, how you're going to manage this, I think using tools smartly, making certain you've got good systems, if there is some consortium or something that might be something really interesting, for especially some of the larger ones, right? Like, AWS, they hardly even let you really do a lot of work on them anyway. They usually just give you their information. But as far as like how smaller banks are going to be able to do that, it's like leveraging technology, having questionnaires that are well built and well suited for your clients, that are basically being automated as much as possible. And that allows you, I think, to have your people like looking at documentation as opposed to hopefully chasing documentation. But there's a lot of good tools out there already to kind of help with that process, and just kind of aligning them in the right way. And hopefully, with the AI kind of thing, maybe that will make it even easier, right? As these things get more developed, that can be done through third parties. So you're really just monitoring this information, and you're getting like feeds in as you're kind of doing. And Dafna sort of spoke to that sort of constant need to have these check-ins, that things are running as they should. So you're just getting informational feeds, overseeing it, ensuring you've set it up properly, and you know what's happening at all times through your systems.
Yeah. So here, how about a hypothetical? Let's say during one of these regular check-ins, your partner says, "Hey, it's been really great working with you folks, but we are in significant financial distress, and we've commenced a strategic alternatives process, and we don't know where that's going to lead, but it could result in a bankruptcy and restructuring, or it could result in us selling the company, or it could result in us winding down." What are the first things that you think about when your partner tells you that they're kind of approaching the end of the line? How do you respond to that in order to mitigate the risks that are presented by that, and hopefully forestall any disasters that might result?
I'm glad I put on somebody on reserve. I'm sorry that you're having these problems, but I sure am glad I spent that extra money to bring on another provider, and I wish you all the best.
The question is, are we talking about the fintech that's leaving a partner bank, or
Yes,
not,
fintech's
sorry,
leaving a partner bank.
That's now going under, goes back to that element of what plan did you put in place, and is that plan pressure tested to be able to be acted on quickly, if it's like you're describing in your theoretical, and how do we quickly take the necessary steps, whether it's, like I said before, warming up or not hotting an alternative servicer, making sure that we are having conversations around any data that's missing, or like really kind of expediting anything that needs to happen.
Yeah, I think Daphna's right. And hopefully, you would understand and of course have all that documented. Are they going through your interface? Is it through their interface? Because that's going to be the primary thing, right? Is ensuring that you've got the customer contact, you've got all the right data, and you'll be able to continue to service those customers, and you have those backup plans in place. So there's no missed opportunity. You want to make certain that you're always thinking of your customers first and foremost. And if you're really doing that throughout your whole cycle, your contracting, through your working with the customer, it should be a fairly smooth transition. Even if the lights go out tomorrow, which I've only had that happen once. That was actually a very long time ago, and it was actually a service provider that went bankrupt very quickly. And we actually just went in and ran the company and kept everything going, and worked out okay.
Yeah. Well, unfortunately, if the bank is not really going to give you a heads up, if they're the ones in trouble, you'll read about it on the FDIC website, just like everybody else in most cases. So
That's
hard
right.
to plan for that
I
version.
guess I think the only other like narrow piece that I would add there is that I think it's occasionally, particularly with many of the smaller banks that play so heavily in this space right now, like the knee-jerk reaction to that news is to focus on anything to do with credit risk and to start calling reserves and to protect the financial position. That is important to do. I'm not discounting that, but to Dafna and Amy's point, like you have to also think about the operational continuity that's going to present itself in the event that those financial protections are sort of all for naught, right? And so like things as tactical as I'm getting X type of reporting monthly today, but if the business goes under tomorrow, like that means I'm 30 days out from the next current report. Like I need more, like I need a higher frequency of data feed to me now, so that I can start to get a backup service provider ready to at least wind down the relationship. And also to make sure that data is in the right format to be transmitted to the bank's own backup service providers. That's it. So like things as nitty gritty as that, and it's like this is why as Amy said earlier, like the contract is so important that the bank needs the right to ask for those sorts of things. So you're not arguing over the like enforcement of the reporting cadence, but it's just okay, in this moment of strain, we need this now, and you're going to need to do it. That's the prudent way to approach those types of problems, not just from a credit risk perspective, but from an ops perspective as well.
Okay, so lightning round to wrap us up here. We just have a couple of minutes, but I'd love to hear one way from each person that this current period of stress will lead to a better, more healthy, and maybe more innovative fintech bank partnership environment going forward. Amy, let's go with you first.
I'm going to go with like better customer experience, right? Because all these things are hopefully going to ensure that there's no hiccups for the customer. So, I think regulation is generally designed to do that. So I applaud that. So I'm gonna stick with better customer experience.
Good. Ryan?
I think we're going to see like stronger operational resiliency as part of these relationships, right? Like no longer can speed to market for these types of relationships be the only and most paramount consideration, but like planning for the rehearsing divorce is going to need to be a part of it, and I think that will lead to stronger relationships and fewer failures.
All right, Jason?
Having more than one provider, it's good. It's good for competition, makes sure everybody knows that each day they're earning their business and making sure everybody is building the best systems. I think there's nothing like competition. And again, when unfortunately one goes, it's good to have that other one. So I'm going to push that. That's mine. Thanks.
All right, you want to wrap us up, Dafna?
Sure. So I'm going to go with one. It's leveling the playing field. And ultimately keeping the bad actors out, because ultimately all of us want to make sure that we're helping those that are underbanked, underserved. So I think that's a big one.
All right, wonderful. Well, we're finishing right on time. Thanks to everyone who joined and spent your afternoon with us. This is a wonderful presentation. Thank you to all the panelists, and thank you to AFC for hosting us.